Welcome to the Explainer. Let's just dive right in. Today, we're opening up the Advisor's Playbook for Mastering the Derivatives Universe. We're going to take an energetic, on-the-ground look at how investment associates actually use derivatives to make real investment decisions. If you've ever felt a little intimidated by terms like calls, puts, or naked shorts, don't worry, we've got you covered. We're going to break down these complex financial concepts, focusing heavily on the core technical understanding of call and put options, and turn those raw mechanics into sharp, executable strategies. Here is our roadmap for today. We'll be moving through the derivatives universe, unpacking calls and puts, hedging versus speculation, advisor strategy profiles, and finally, mandatory compliance hard stops.
Section 1. The derivatives universe, the specialized toolkit.
Okay, so derivatives fundamentally redefine what we're actually trading. Unlike stocks, which give you actual ownership in a company, or bonds, where you're essentially lending money, derivatives are totally different animals. They are simply contracts. Their value is purely derived from an underlying asset. So why do advisors even use them? Well, it boils down to two main purposes. You either use them as a highly sophisticated tool to manage and reduce risk, or you use them to aggressively amplify a directional bet in the market. And right away, we hit the great divide in the derivatives universe, options versus futures. The absolutely crucial distinction here? An option gives the buyer the right to exercise the contract, but there is zero obligation to do so. You just pay a premium for that privilege. A futures contract, on the other hand, creates a strict obligation for both parties to complete the transaction. There's no upfront premium, but you've got to put up margin. Having the right to do something versus being legally obligated to do it is a massive difference when you're managing a client's risk profile. Section 2. Unpacking calls and puts, the core mechanics. To really get this, you have to understand these two opposing forces. A call option gives the buyer the right to buy the underlying asset. You'd use this when you have a bullish outlook, meaning you want the stock to rise above your strike price, plus whatever premium you paid. Conversely, a put option gives you the right to sell. This is a bearish position, but it's also incredibly common as a hedge. Think about it. If you own a stock and you're terrified it might crash, buying a put acts exactly like portfolio insurance. Every single investment associate on the floor has these asymmetrical risk profiles burned into their brain. Let's look at the dynamics here. For the buyer of an option, your maximum loss is strictly limited to the premium you paid. That's it. It's a defined risk. Your safety net is literally built in. But flip over to the seller gets to collect that upfront premium, but in exchange, they take on massive risk, potentially unlimited loss. The buyer has a floor. The seller, very often, they do not. Now, to actually build these positions, you've got to know your raw materials. The premium is the non-refundable price the buyer pays. The strike price is the fixed, unchanging price where the contract executes. Then there's the expiry date. This is a strict deadline. After this date, the option literally ceases to exist, which introduces the whole concept of time decay. And finally, leverage. A tiny premium controls a massive amount of value. A 10% move in a stock can mean a 100% gain, or a total complete loss of your premium. Leverage is basically the magnifying glass of derivatives. Section 3. Hedging versus speculation, the why. Probably the most important concept to grasp is that the exact same financial instrument can be a deeply responsible, calculated move or a wild gamble. It depends entirely on context. Hedging is all about risk reduction. It's insurance. You're protecting an exposure you already have. Speculation, though, that is risk-taking. You don't have an underlying position. You're purely using leverage to make a directional bet on where a price is heading. Okay, let's put you directly in the advisor's chair to test this out. Imagine a wheat farmer who just planted 50,000 bushels of wheat. He's worried about a sudden price collapse, so he enters a futures contract to sell those 50,000 bushels at today's price exactly 4 months from now. Think about the core intent here. Is this farmer hedging or is he speculating? If you said hedging, you hit the nail on the head. The absolute crucial detail here is that the farmer already planted the wheat. He has an existing underlying exposure. If the price of wheat collapses, sure, his farm suffers, but his futures contract will gain value, perfectly offsetting that loss. It is pure price insurance. He's not trying to get rich off the futures market, he's just trying to lock in his survival. Section 4. Advisor strategy profiles, on-ground decisions. Let's run through another scenario to see how an associate makes these on-ground decisions. A client calls in, right?
They firmly believe Shopify stock is going to rocket up significantly over the next 3 months. They want in on that upside profit, but they're risk averse. They only want to risk a small, strictly defined upfront cost. So which specific option strategy perfectly solves this client's problem? The associate should advise them to buy a call option. Remember those core mechanics we talked about? A long call gives you the right to buy, making it the absolute perfect bullish position. But the real kicker for this specific client, the maximum loss is strictly defined. If Shopify absolutely tanks, the most they lose is just the premium they paid. They get that limitless upside exposure, but with a hard, secure floor on their downside risk. But, we really can't talk about strategy without talking about the darkest corner of the derivatives market. Theoretically, unlimited loss potential. It is the most dangerous and heavily scrutinized concept in the entire industry. So what actually creates that unlimited loss? The naked call. This happens when a trader sells a call option, promising to deliver shares at a specific strike price, but they do not actually own those underlying shares. Why is this so terrifying? Well, because a stock's price can technically rise to infinity. There is literally no ceiling. If a stock you shorted via a naked call skyrockets, you are legally obligated to buy those shares at the exorbitant, soaring market price just to hand them over at your tiny, low strike price. This strategy is so risky it requires the absolute highest level of advisor approval and is basically suitable for almost zero retail clients. Section 5. Mandatory compliance hard stops. Now, out in the real world of derivatives, paperwork isn't just a gentle suggestion, it's a hard stop. The two most critical documents are the Derivatives Trading Agreement, or DTA, and the Risk Disclosure Statement. The DTA is a formal contract that sets out exactly what types of derivatives a client is even approved to trade, based on things like their net worth and knowledge. The Risk Disclosure Statement ensures the client actually understands that they could lose their entire premium or face aggressive time decay. This isn't just about checking a box for a signature, it's about verifying genuine, informed consent. And there is a very strict, mandatory order of operations that an associate absolutely must follow. Step 1, the Know Your Client or KYC assessment to figure out general suitability. Step 2, the client must sign the DTA to lock in those approval levels. Step 3, they have to sign and actually demonstrate they understand the risk disclosure. Only after all 3 of those steps are perfectly complete can we finally arrive at Step 4, executing that very first trade. Let's look at one final, super high-pressure scenario. A new client comes to your desk. They have a massive portfolio, decades of vast options trading experience, and they want to execute a time-sensitive options trade right this exact second to catch a fast market movement. But their paperwork isn't fully processed yet. Can the advisor execute the trade today just to keep this VIP client happy? Absolutely not. No way. If you execute that trade, it is a massive compliance violation. In the highly regulated world of derivatives, no DTA on file means no trading, period. The urgency of the market does not matter. The client's decades of experience, totally irrelevant. The administrative sequence is an absolute compliance hard stop, with 0 exceptions. And that brings us to the end of our explainer. We've gone from defining a basic call and put all the way to understanding the catastrophic risks of a naked call and the unbending, rigid rules of compliance. So the final question I leave you with is this. With the incredible leverage and power that these instruments provide, are you ready to manage the risk and master the derivatives toolkit out there on the trading floor? Thanks for joining and keep on learning.